The Federal Reserve quietly held an emergency closed-door meeting with major Wall Street banks this week, setting off alarms across the financial world and triggering fears of a looming liquidity crunch. According to senior financial officials, the meeting was called after an unexpected spike in demand for short-term funding, a sign that banks may be running tighter on cash than they are willing to publicly admit. Borrowing from the Fed's key lending facilities surged to its highest level in years, signaling stress deep inside the financial plumbing of the U.S. economy. Behind the scenes, Fed officials pressed major dealers on whether short-term market conditions were deteriorating, especially in the repo market, the critical engine that keeps trillions of dollars of daily transactions flowing. The tone of the meeting, described by one participant as urgent and uncomfortable, has fueled speculation that liquidity pressures may be building faster than expected. Analysts warn that once these cracks appear, they can spread quickly. A liquidity squeeze can hit everything: bank lending, corporate financing, credit markets, and ultimately the stock market. It raises borrowing costs, reduces access to cash, and increases the risk of sudden asset sell-offs. What makes this moment especially tense is that the Fed has been laser-focused on inflation and interest rates, not liquidity risks. An emergency meeting of this nature signals a possible shift. The central bank is worried about funding stress returning to the spotlight, just like in 2019 and early 2020. For investors and businesses, the uncertainty is real. Is this just a precautionary check-in? Or is the Fed bracing for a deeper market shock? If confidence in liquidity starts to erode, the financial system can seize up with little warning. One thing is clear: the Fed doesn't call emergency meetings unless something feels off. Don't forget to like, comment, and subscribe for rapid updates on this developing liquidity story and the global market fallout.